The total return formula is in a very tenuous moment simply because of where yields are and where inflation is expected to be. Some people consider Jeff Gundlach your successor when it comes to the Bond King moniker. You may disagree. Others do. The question I have is, do you agree with his prognostications of a 10% inflation rate this year and the likelihood that the Fed is vastly behind the curve?
Well, the latter, yes. A 10% inflation rate is problematic. We'll see a little bit of it tomorrow, and it depends, of course, on commodity prices, oil prices, and the wage follow-on. But I do think inflation will be in a 4 to 5% category for the next several years. And does that validate a 10-year at 180 or 85? It does not. Does it mean that there'll be a huge amount of sellers because of the lack of Fed buying? Probably not. As we've seen in the last few weeks, treasuries are a safe haven, much like gold. And so investors are content to stick at 1.8% until the coast clears. I do think, though, that bonds are a risky investment here. Durations are very, very, very low as almost they've ever been. And so when inflation is accepted in the marketplace at 4 to 5%, which I think it might, then bonds are a sale. And once we get above on the 10-year, once we get above 215, I think there's substantial risk. If you give me just 1 second, there's a long-term trend, a 35-year downward trend in terms of the 10-year and the 30-year that hasn't been broken. It's one of the most amazing trend lines that exist in financial markets. And right now, the 10-year at 215 would break the downward trend for 35 years. And so I think that's critical, but I think it will happen.
So you do think that trend will be broken, but do you think that we're going to escape the negative real yield vortex, or do you think that that's going to persist?
Well, it might in certain areas. I mean, there are fewer and fewer negative yielding bonds. I think we're down to 4 trillion as opposed to 15 trillion. And the German 10-year is up at a magnificent 8 basis points this morning. I think ultimately we have to, as a finance-based global economy, negative interest rates are definitely a negative, a detriment to economic growth because they encourage or discourage savers, which is the thrust of investment. If you don't have savings, you don't have investment. And to a certain extent, if you stay down there in negative territory, investors will put some of that money into a mattress, and it doesn't do very well in terms of productivity in a mattress.